Okay, so that first one. Eric runs a business selling gym equipment. Eric buys a vehicle for business use and takes out credit from Wheels Limited. So they purchased a vehicle and took out credit. So that means the source document has to be the purchaser's invoice. It's not a receipt, it's not a bank statement, purchase invoice, no cash has been exchanged yet. The book of prime entry. Now you might be thinking it's the purchaser's journal. However, the vehicle's business use and it's a non-current asset, so non-current assets go in the general journal. Remember, the purchaser's journal is only for purchase of goods that are going to be resold. And then two accounts. Well, one's going to be the vehicle account, and the other one is going to be Wheels Limited. Now, to work out which way around it is, just try and think which one's your asset, which one's the expense, which one's liability, which one's income. Well, vehicles is the asset, and that's went up, so that's my debit. And Wheels Limited is my supply, so that's my liability, so that's my credit. Okay, second one. Eric bought the vehicle for £12,000, so the cost is, £16,000. He depreciates it using a straight line method at 20% per annum. So the first thing we want to do is work out what's 20% of 16,000. So you use your calculator, you get 3,200. So that's how much depreciation it is a year. Times that by 2 to get 2 years. £6,400 depreciation altogether. Then take it away from the cost. So 9,600, and that's our net book value. So that's how much the vehicle's worth now. And we sold the vehicle for 8,000. So that's less than how much it's worth. So we're going to make a loss. And to work out the amount, we take it away. It's 9,600. Take away the £8,000, which is 1,600 loss. Okay, third one. Eric's accounting year ends 30th of April 2020. So I've got April 2020. So that means it began May 2019. He's put £2,000 for rent on his income statement. So that means he's paid £2,000 rent on the income statement. However, Eric has included his rent payment of £900 for the year ending 31st of July 2020. See if you can see that. So there's July 2020. So he's paid for a year's rent, which would have started in August 2019. So hopefully you'll agree that some of this up to here should be included, but some of this after here is prepayment. So the prepayment bit is the bit we don't want. So what we're going to do is we're going to do 900 divided by 12 to work out how much it is per month. So 900 divided by 12 gives us £75. And £75 is how much you should pay each month for rent. And this bit is a prepayment. So we prepaid the months after April. So we got May, June, and July. So we prepaid 3 months. So do £75 times 3. So 225. So we've made 225 prepayment. So that means we need to take that off the £2,000. We get 1,775, and that goes in the income statement because how much should have been paid for this whole year. And that 225 will go on the soft, and it's an other receivable because it's money we own, and it would be a current asset. Okay, fourth one. Eric is paid for £50 fuel by debiting cash and crediting vehicle expenses. So this is how it looks. So we got my cash, and we've got vehicle expenses. So he's debited cash for 50, and he's credited vehicle expense for 50. We look at how it should look. So cash, if we pay for something, that's on the credit side of our cash because money going out, and it's on the debit side of our vehicle expenses because vehicle expenses is an expense, and that's a debit account. So to make that happen, we need to credit cash by 50 and debit vehicle expenses by 50. So to get from 50 on the other side to the 50 on this side, I need to, first of all, have 50 to cancel it out, and then put 50 in I want. So altogether, it's going to be 100 on the credit side and 100 on the debit side. So the name of this error is complete reversal. And my general journal entry would look like, it would start on the debit, so it'd be vehicle expenses. So there's my debit, there's my credit, 100, and then it would be cash, credit, 100. Then if you had to write a note would just say correction of error reversal. And the last one, number 5, it says Eric has sold £100 worth of goods to Erica on sale or return basis. Remember, that means Eric is acting as a middle person. So the goods are still Eric's until Erica sells the goods on. Erica has not yet sold the goods, but Eric has included the sale in his accounts. So that means the 3 accounts that's been affected. So sales has been affected if he thinks he's made a sale. Inventory's been affected if you think he's made a sale, and trade receivables are affected because he thinks Erica now owes him that money. So to adjust them, well, sales, I need to take with £100 because Eric hasn't made the sale yet. Inventory, I need to plus £100 on because he still has that inventory. Erica hasn't sold yet for him. And trade receivables, I need to take with £100 because Erica hasn't sold it on yet. So he hasn't got that £100 from customers that they owe him yet. And the name of this concept is realization, because the transaction hasn't happened yet. So the rights of the goods haven't been transferred yet. So they still belong to Eric. You could also put prudence, you could also put accruals. The main one is realization.